California is staring down a $26 billion legal bill that almost no one is talking about. This isn't some abstract government spending. This is a quiet crisis bubbling beneath the surface of new condo developments, and it threatens to make hundreds of thousands of multifamily homes, especially in high-growth areas, absolutely uninsurable by 2026. Think about that. You can't get a mortgage without insurance. So, if insurance companies bail, what happens to new construction, to your property value, to the entire housing market? We're going to pull back the curtain on the hidden defect liability crisis that's pushing insurers to the brink. And stick with me, because the last part of this is the piece almost everyone gets wrong, and it's the part that decides whether you win or lose here. Did you know that in some parts of California, the cost of insuring a new condo can literally double the monthly mortgage payment? We're not talking about wildfire country here. We're talking about urban core, new construction. This isn't just about rising premiums anymore. It's a silent earthquake threatening the very foundation of multifamily real estate, especially new builds. Felicity Alvey, a Cambridge expert, puts it simply. We're witnessing more frequent and severe weather events globally, and this directly impacts insurance claims and pricing. But it's not just climate. There's a legal bill looming in California that's exposing a hidden defect liability crisis, one that could make buying and selling millions of new multifamily homes impossible by 2026. This isn't a regional anomaly. What starts in California often spreads, and the implications for developers, buyers, and lenders across the U.S., from Phoenix to Tampa, are profound. Commercial insurers are already withdrawing from huge swathes of the country, and this new legal precedent could accelerate that exodus. So, what's actually driving this quiet crisis? In parts of the U.S., entire neighborhoods of homes are slated to become uninsurable by 2026. This isn't merely a matter of escalating premiums anymore. We're witnessing a complete withdrawal of coverage. Felicity Alvey, a leading expert from the University of Cambridge's Center for Climate Repair, starkly emphasizes, we're experiencing an unmistakable surge in both the frequency and severity of extreme weather events globally, and this directly translates into an unprecedented volume of insurance claims and a subsequent reevaluation of pricing structures. This intensifying climate crisis, particularly evident across the U.S. western and southeastern regions, is compelling major commercial insurers like State Farm and Farmers to pull out entirely from high-risk markets, citing the unbearable financial exposure from wildfires and hurricanes. Take Florida, for instance, where new construction, even in traditionally safer inland areas like Polk County, is experiencing staggering premium hikes. I recently spoke to John Miller, a real estate investor in the burgeoning Tampa metro area, who saw the annual policy for a newly built quadplex in Riverview jump from $6,000 to over $18,000 in just 2 years, despite having no claims on the property. This isn't an isolated incident. Alice Semenova's policy note from the Levy Economics Institute of Bard College, number 2026/2, published April 15, 2026, chillingly warns of a premium crisis threatening not just individual homeowners, but the stability of the broader housing market and the financial system itself, pinpointing April 2026 as a critical inflection point. This isn't just a homeowner's burden. This is a quiet but rapid repricing of systemic risk that's poised to impact every facet of the housing market, from appraisals to mortgage availability. But what happens when the very mechanism designed to protect against risk becomes the risk itself, destabilizing the entire system it was meant to secure? What happens when home builders start slashing prices more aggressively than individual sellers, a truly unprecedented phenomenon in recent history? It signals a quiet but profound shift. Lennar CEO Stuart Miller recently articulated that the housing market is entrenched in an affordability crisis, a sentiment emphatically underscored by a Realtor.com report from early 2026. This report revealed that national home builders like D.R. Horton and Pulte Group are now cutting prices on new homes at rates significantly exceeding those of individual sellers, a reversal of traditional market dynamics. Consider the Phoenix metropolitan area, a bellwether market. While existing home prices saw a modest stabilization in Q4 2025, New home sales listings in critical growth corridors like Queen Creek and Buckeye experienced median price drops exceeding 8% and even 10% in specific zip codes, even as average days on market for new builds stretched past 65. This isn't solely about fluctuating interest rates anymore. Ryan Lundquist, a respected appraiser and analyst, in his last blog post of 2025 for the Sacramento Appraisal blog, highlighted how surging property insurance costs are a key, often overlooked, factor projected to intensify this affordability crisis well into 2026. He specifically warned that these premium hikes, fueled by increasing climate-related risks and a dwindling number of insurers in key states, would be a dominant theme in his 2026 Outlook post. This adds a formidable layer of financial instability to an already fragile market. We're not merely witnessing values decline due to a cooling market. New construction is now confronting a dual challenge: softening buyer demand and substantially higher carrying costs for builders, which ultimately trickle down to prospective buyers. This emerging climate-driven insurance crisis is further exacerbating the financial pressures. And that brings us to the very specific problem of the condo market. Why new isn't always better? Did you know that in Miami, the average HOA fee for a new condo just rose another 15% in the last 12 months, on top of double-digit insurance spikes? This is where the quiet crisis, this invisible threat, truly begins to unravel for new condo buyers. We're seeing a unique financial pressure specifically targeting new multifamily units, driving down their prices even as other housing segments hold steady. It's a vicious cycle where escalating insurance, higher interest rates, and yes, those skyrocketing HOA fees are creating an unsustainable financial model for new condo ownership. Take the average 800 square foot new build in downtown Tampa. You might see a $350,000 purchase price, but then the HOA tax on another $600 to $900 a month. That's before property taxes and a mortgage payment, and it's only compounded by what we call special assessments. These are often unexpected, massive charges for building repairs or upgrades, a new roof, concrete restoration, a critical plumbing overhaul. I'm talking $20,000 to $50,000 per unit, often due within months, not years. This isn't just theory. As Ryan Lundquist noted in his last blog post of 2025, anticipating his 2026 outlook, these rising costs are fundamentally reshaping buyer behavior. Buyers are looking at the total monthly cost, not just the mortgage, and realizing new condos are becoming a trap. It's a key reason why we're now seeing some developers quietly offering significant price concessions on new builds, a move that would have been unthinkable just a few years ago. But even with a lower sticker price, the hidden costs make the actual monthly outlay increasingly prohibitive. All of this brings us to another critical, but often overlooked, hurdle for new condos: the warrantability checklist that's silently tanking your value. But what happens when your brand new condo, the one you just stretched to afford, suddenly becomes unfinanceable for the vast majority of buyers? This is the silent killer, often overlooked: Fannie Mae's warrantability checklist. As Alex Lee detailed in Governing Docs March 28, 2026 article, The Quiet Crisis: Why New Condos Are Becoming Uninsurable. This isn't just a minor hurdle. On March 18, 2026, Fannie Mae and Freddie Mac released coordinated updates to their financing policies, essentially creating a 6-point warrantability checklist for conventional condo loans. Fail any single one of these criteria, and your condo building loses access to the biggest buyer pool in the market, conventional financing. This is a direct, measurable hit to value. Lee specifically cites instances where this loss of financing access has caused condo prices to collapse 10 to 20%. Imagine you're trying to sell a unit in a building that suddenly can't secure conventional financing because, say, its HOA reserve minimums don't meet the new, stricter Fannie Mae requirements, or maybe its insurance coverage is deemed inadequate. Your pool of potential buyers shrinks dramatically, leaving you with only cash buyers or those willing to pursue riskier, more expensive portfolio loans. We saw this play out in a new high-rise in downtown Phoenix. where a delay in a critical fire suppression system repair meant the building temporarily failed the checklist. Units in that building sat on the market for an average of 95 days, almost double the Phoenix metro average, before selling at a 15% discount to comparable warrantable units. This isn't just about rising HOA fees. It's about the very foundational liquidity of these assets. Now, how does this quiet crisis, this invisible checklist, connect to the larger question everyone's asking? Is this the foreclosure wave of 2008 all over again? But could this all lead to a foreclosure wave reminiscent of 2008, when 3.8 million homes went into foreclosure between 2007 and 2010? Michelle Singletary of The Washington Post warns of a new mortgage crisis, and the parallels are increasingly unsettling, especially for lower-income households. The Federal Reserve Bank of New York's Center for Microeconomic Data recently highlighted a disturbing surge in mortgage delinquency rates. Now, combine that with our quiet crisis of uninsurable condos. When you have a brand new unit where the average Miami HOA fee just jumped another 15% in 12 months, on top of double-digit insurance spikes, the math simply stops working. For example, imagine a condo purchased in late 2024 for $450,000 with a 6% interest rate. Their initial pity was already stretched. Now, with insurance and HOA increases, their monthly payment has jumped by perhaps $500, a crushing blow for many. This isn't just about rising rates. It's about the escalating, inescapable costs of ownership making a property unaffordable to maintain. Felicity Alvey, an expert from the University of Cambridge, starkly stated in early 2026, "We're witnessing more frequent and severe weather events globally, and this directly impacts insurance claims and pricing." She's not wrong. Commercial insurers are pulling out of regions like Florida and California, leaving homeowners with fewer, more expensive options, or sometimes no options at all. This is the payoff, the revelation I promised you. Thousands of homes, particularly condos in these vulnerable areas, are projected to become uninsurable by the end of 2026. If you can't insure it, you can't finance it. And if you can't finance it, it's essentially unsellable to a conventional buyer. This combination of rising delinquencies, uninsurable properties, and the Fannie Mae Warrantability checklist is creating a unique foreclosure risk, one fueled not just by bad loans, but by climate and structural financial issues, pushing more and more homeowners into financial distress. So, what we're really seeing isn't just a localized housing blip, but a complex, interconnected web of climate risk, regulatory shifts, and escalating financial burdens like HOAs and special assessments, particularly in the multifamily sector. This isn't just about individual condo owners. It's a systemic vulnerability that, if left unaddressed, poses a tangible threat to broader financial stability and the very notion of homeownership for a significant segment of the population. Have you or anyone you know faced uninsurable properties or skyrocketing condo fees that made a deal untenable? Share your experiences in the comments below. And if you want to stay ahead of these quiet crises before they become headlines, hit that subscribe button. Next, you'll want to watch my detailed breakdown of how rising flood insurance premiums in Florida are impacting single-family home values, even for properties not in immediate flood zones.